flagged, but also, therefore, I think we ask ourselves every day we wake up when we're actually going to see it start to crack equity markets overall. And we see tremendous potential for earnings resilience at infrastructure businesses over the next 2 years. So these are still businesses fundamentally that can grow earnings and cash flows in the high single to low double digit. In transportation infrastructure, you have a nice tailwind, particularly in the leisure travel space for toll roads and airports, where people are still picking up mobility, and maybe therefore mobility continues at a stronger clip than you would typically expect in a recessionary environment. So that earnings resilience piece, I think, will be key for us over the next 2 years, if we ever get a recession. And then the last point I'll make from an infrastructure investment perspective is I think there's obviously a lot of talk out there around sustainable investing and ESG. And from our perspective, infrastructure is the ultimate sustainable investment, because these are businesses that are tasked every day with balancing the E, environmental, the S, social outcomes, affordability, access to electricity, access to clean water, and economics. If they don't balance these three pillars, then they cease to exist as a going concern, and really it prevents them from long-term value creation. So I think that sustainability piece of infrastructure will become more and more important over the next decade.
Let's keep going with recession. Might be the word of the year. You hear about something about a recession almost every day. Is it going to happen? When is it going to happen? So for you all, what is the concern there, and what's kind of the scary thing about infrastructure investments if we do go into a recession, and whether if it's a pretty mild recession or a pretty bad recession? Like, what are some of the concerns for you all there when talking to clients on how they should be investing?
So I'll start with that. I think, so in my business, we're effectively credit risk arbitragers. So for Assured Guarantee, we wrap and provide our financial guarantee over these assets, and we take long-term risk. And so when we see a recession, typically what happens is credit spreads widen out. And if you look at, sort of on my side of the business, the fixed income side and infrastructure, we haven't necessarily seen that credit spread widening because there's plenty of investors that want that asset class. So the recession sort of starts with wider credit spreads, which in the short term is actually pretty good for our business. It allows us to be able to get more pricing power and increases the value of our product. So our product actually tends to do very well in recessions initially. But as you think about long-term sort of credit risk taker, 30 years, we don't sell out of our position. We're here for 30 years, 40 years. Obviously recession does put pressure on the people's ability to go and do leisure trips, to be able to spend on water sewer charges, everything, right? A recession obviously has all that impact. So, we tend to, when we go into a transaction, we try to, we expect and we model all the cash flows based off of, what we expect in terms of a recession. And so what we've seen, time and time again, as Emily, mentioned, is that, these are very resilient assets. And so whether it's a shock, as I mentioned before, 9/11, SARS, COVID, I can go on and on and on, we've seen these assets actually perform reasonably well. Hence the reason why investors continue to want to put money to work in this asset class. So I think from a recession standpoint, it's manageable. The things that we worry about are the things like COVID-19, those type of shocks that are sort of unforeseen, and what that does for certain some classes of infrastructure assets. So, for example, COVID-19 was particularly problematic for transit agencies, right? What we've seen is immediately people drove their cars instead of getting on trains and planes. And then that started to change. People got on planes, but still aren't getting on trains. They're driving their cars in. The smog we have here in New York right now is not because we're driving, obviously, but a lot more traffic has sort of, so we've seen that toll road traffic in a lot of cases has performed, pretty well. So again, the recession does have some challenges. We look through that recession. We expect recessions. The interesting thing, from my chair is I think we were heading towards a credit rollover before COVID-19. We've had a long sort of run, low rates. And then COVID happened, and the government just started spending for all the citizens effectively. And, you know, a lot of the transit agencies, a lot of the airport operators got a lot of money from the federal government, which has provided them with a lot of support. In addition to demand coming back, they've also got cash that's come in the door. Excuse me. So that's really been an interesting sort of part of this cycle. But going forward, I think, you know, this money is going to stop flowing. And what I think again, back to the sort of, you know, what a recession, a lot of times you can build out of the recession, right? How do you get out of a recession? You spend, right? And a lot of these, you know, projects could help put people to work that wouldn't otherwise be working. The hard hats out there, those folks would be working on these projects. And so what we've seen is, despite the talk in Washington, the money that comes in is really going out. And what it's going out for is the projects that are already under construction. Inflation is pushing them. And so they're using this additional federal dollars to tamp down the inflation on existing projects and not doing new projects, right? And so I think really that is one of the things that I spend a lot of time thinking about in the recession, because, you know, again, one way we can get out of a recession is to do these infrastructure projects. I mean, if you think about, you know, under the Obama administration, there was Build America bonds, right? The Build America bonds were really, for international investors, this was it was like, I can get fixed income, you know, traditional infrastructure assets, and they're taxable, and I can buy this. And it was a riot. I mean, people really loved this asset class. And that was partly the idea, was we're going to build our way out of this recession. So my concern is, we go into a recession, we don't have the projects in the pipeline to be able to put those folks to work. And I think that's sort of the bigger picture when I sort of think about it. We just don't have enough projects. And, you know, I'm happy to talk more about why we don't have enough projects. And it's pretty simple. People don't want to pay taxes, and they don't want to pay user fees to use the assets as well. I mean, that's really what it comes down to. Despite the fact that if you came over the George Washington Bridge to get here, you probably paid like $20 to cross over the bridge. But, you know, again, there's a lot of pushback on trying to get those assets, to get the cash flows that are necessary to get the return that Emily and the investors really want. So that's the reason why we don't have more projects. And I think, again, the recession question is, are we going to be able to build our way out of it when and if a recession actually occurs?
Yeah, and then, so I think Randy did a great job, right? So when we think about the recession and what we're worried about, I think the key takeaway for us as infrastructure investors is the infrastructure, the risk of a recession is manageable, right? So I'll steal your word.
Exactly.
We do expect a lot of resilience, going back to my initial comments. I'll make two other points, though, because infrastructure, of course, there are a lot of ways to access infrastructure, and both Randy and I are up here speaking about accessing infrastructure through the public markets. And so 2 points that I would highlight where we actually think accessing infrastructure through the public markets could be advantaged over private market investing over the next couple of years. The first one has to do with portfolio diversification. So when we're talking about municipal bond portfolios, right, these are tens or hundreds of bonds that are in a single portfolio. In our case, we're owning tens, 20, dozens of companies that each operate multiple underlying assets. And diversification is important in this type of environment, because as investors, we really need to be protecting portfolios against the unknown unknowns, right? And diversification is the best way, in our experience, to really do that, to make sure that even if you have an unanticipated shock at one of your investments in your portfolio, it doesn't impact your forward-looking returns of the overall portfolio. I think in private market infrastructure portfolios, it's harder to do that because you're just simply more concentrated on a smaller subset of assets. And then the second point I would say is that I'm going to call it a stock picker's market, but I think this is a market for active managers, right? And that's quite exciting in the public markets, because we have tons of opportunities to shift and tilt the portfolio to take advantage of opportunities investing in businesses and sectors and geographies that should be even more resilient than your average infrastructure business to a recession. So, for example, right now, we're reflecting in a portfolio a bias away from transportation infrastructure in favor of sectors like communications infrastructure, which benefit from long-term structural trends that we're going to need more data whether or not there's a recession or not a recession. So that resilience and opportunity in an active public infrastructure portfolio to tilt towards those different subsectors, we think is quite differentiated right now.
And so when a client comes to you all and they're not familiar with the infrastructure space, why is the infrastructure space, keep saying space, an area that they should possibly get in on? And is now a good time to be coming into the infrastructure space, or kind of what are your thoughts there on if now's a good time or when might the time be?
Well, so I'll start. I mean, we always think it's a good time to invest in infrastructure. It's what we do, all day, every day. I think, when an investor or somebody comes, so if you think about our product, short guarantee, the financial guarantee, we homogenize infrastructure. So, if it's a public-private, toll road that's, barely investment grade, say, Baa, 3, if we get involved, our financial guarantee sort of makes it, a AA S&P rated bond, right, which increases your ability to market the, to sell the position. It'll usually outperform when rates move against you. And again, it allows the investor not to have to think about all the details that we think about when we're investing. And similarly, and if you think about it, I mean, same thing, on Emily's side, you're going to invest in her fund, right? She's going to do the work and she's going to provide you the return, right? You're going to be aware, you're going to know what she's buying. In the case of, our investors, they know what they're buying, but they want that extra protection. They want our credit expertise. They want our capital support. They want our, again, the liquidity that we offer to the marketplace with our financial strength rating. So that's usually what we talk to investors about. And, a lot of times, if you think about, who the investors are in infrastructure, a lot of them are ultimately retail investors. And if you think about who's financing it, of course, we've got listed equity, but the project sponsors almost all over the world are public entities, right? And so these public entities are, looking to access capital, but they're also looking to diversify their investor base. And so what we do is we allow more retail investors to get exposure without having to fully understand all the nuances and details of the project. So that's, and so the answer to your sort of second question of, I answered it earlier, I think it's a great time to get involved in infrastructure. It performs well in I think, many market settings, aside from when we have the random shock. But even under that scenario, a lot of these assets and a lot of these operators have a tremendous amount of cash on their balance sheets. They're very conservative. And again, the demand profile for these assets is extremely inelastic. And so their ability to pass through price increases is usually very high. So all of those factors mean it's pretty good to invest all the time across all different market dynamics. I mean, I talk my book too much, but I mean, I think it's true. I mean, I believe it. I mean, I would put my own sort of, coin behind, infrastructure. I think it's an asset class. And again, all things are relative. Like, I mean, if you're going to, get involved in AI, maybe your infrastructure performance is going to underperform in certain markets. But, to Emily's point, I mean, if you look at equity returns versus what, infrastructure did, I'd be doing infrastructure all day long last year. So that would be my view.
Yeah, and I would just say, in addition to us both being bullish on infrastructure overall, I think if you take a step back and think about strategic allocations for both institutional and retail investors, the reality is infrastructure as an asset class is still in the relatively early innings. We're seeing a lot more today than we did 10 years ago. Both institutions and retail investors have broader real asset buckets in their portfolio, but particularly in the public markets, I think that's still even earlier than it is for institutional investors in terms of the adoption. And the most frequent range that we see is across a multi-asset portfolio having a real asset bucket of 0 to 10%. And so infrastructure within that, depending on relative opportunity sets, anywhere from 1 to 5% of an overall portfolio. But the real strategic opportunity is for investors that don't have any exposure to infrastructure to continuously add it in the portfolio. And for that reason, it's actually more strategic than tactical in many cases. And that's part of why I think I can be comforted by being a perma bull in this space.
What keeps you all up at night? We all try not to take work home with us. I mean, if you're working from home, it's home with you. But what keeps you up at night? And are there any sectors within this space that are high risk and that you wouldn't recommend an investor get in on right now?
Well, I mentioned transit. I mean, transit has had a bit more of a difficult run here, just because, if you think about transit, and we're sitting in a city in New York here, which has more transit than probably any place in America, certainly, and maybe even the globe. It doesn't, in and of itself, the fare box revenue does not provide enough for operations and capital. So, there's a lot of tax support that does come in, but the fare box revenue is important. And they've seen a tremendous, sort of decline in ridership, and therefore the revenue streams have declined as well. I think, some of the things that sort of keep me up at night are like the shocks, like I mentioned. Nobody foresaw COVID-19 happening. Things that occur, global, tensions that go on, that could have, and sadly, when there are tensions, infrastructure gets actually destroyed, in certain cases. And so rebuilding that infrastructure, what happens if you have climate change is another thing that, keeps us up at night. Sea level rise, things like that. When you sort of think about, for us, taking 30 or 40-year risks, we spend a lot of time thinking about what the climate's going to look like, what's windstorm, earthquakes. There's a lot, wildfires as we look around. There's a lot of those type of perils that, we spend a lot of time thinking about and talking about and trying to analyze and ring fence and protect ourselves and our investors against as well. So those are the things that sort of, keep me up at night. And then again, new structures coming in, new ideas that, whether it's, I don't want to say sort of AI, but there's different sort of telecommunication things that are happening that are new, where it's infrastructure, people feel good about it, but maybe it's still technological risk associated with it, and we don't know if that, for example, lithium batteries, right? Maybe lithium batteries are going to be what are going to power cars, but they're catching on fire in a lot of cases. So maybe it's not lithium batteries, maybe it's something else. Well, if you're an owner of Tesla, right, or you're an owner of somebody that's like very much in the battery business, maybe there's going to be another competing technology. So those are the things that keep me up at night.
Yeah, so I'll be relatively brief. I'd say two things. The first one is that I highlighted an opportunity in the public markets to position a portfolio defensively. Our portfolio is positioned defensively, right? So we're running higher cash than we would in a typical environment. We're exposed to more defensive subsectors within the infrastructure space, intentionally focused on businesses that we think are more resilient, so kind of upping the ante in terms of balance sheet quality, for example. And so the kind of big area where we could be wrong, right, is what if there is no recession or deep recession or things don't break as a result of the tremendous interest rate increases that we've seen globally over the last 12 to 18 months. That is a scenario. I would say it's not the scenario that we expect, nor is the scenario that we're reflecting in our portfolio, but I would say that's the big kind of where could we be wrong in terms of how the portfolio is positioned. And then the second one, I think, is goes back to some of the points I was making around infrastructure being the ultimate sustainable investment. And so infrastructure is a reflection of where we are today. These are assets that we have built over many years, many jobs associated with these assets. And as a result, these are businesses that need to transition to be responsive to the clean energy transition that's occurring here in the US as well as globally. Today, as it stands today, infrastructure businesses in our investable universe are 4 times more carbon intensive than MSCI World on an equity basis. And so when you ask the question of what keeps you up at night, I worry a bit sometimes that these are fantastic investments that are critical to us making the clean energy transition as a society. But if you want to be purely exclusionary in your approach for investing, then you might not have exposure to these types of businesses in your portfolio. And I think that's a mistake. So I would say don't do that. But I worry that sometimes the oversimplification of the ESG and sustainability debate results in capital flows away from businesses that have complexity, but therefore opportunity for social and environmental impact.
Awesome. Well, we'll just leave it at that. And I appreciate your time today.
Yeah.
Randy, Emily, thanks so much for joining us today. I'm now pleased to continue things with the discussion on how new capital creates better communities. So let's now, yep. Thank you so much. And now, please welcome Anays Payne of Lafayette Square in conversation with Bloomberg's very own Claire Aubusson.
Thank you, Scarlett.
Hi, thank you.
Hi, everyone.
Hi.
Right here?
Shall we?
Yeah. Okay. Hi, good afternoon, everyone. Thanks for being here. My name is Claire Aubusson. I am the program manager for Bloomberg New Voices. Thrilled to be here today, and I'm very pleased to be having this discussion about how new capital creates better communities with Anays Payne, managing director of real estate at Lafayette Square. So just a little bit about Anays. She's leading the build-out of the firm's real estate division and serves on its People Practices Committee. So Lafayette Square's mission is to create investment opportunities in overlooked places and underserved markets. Thanks for being here.
Thank you. It's great to be here. I dressed up for you guys. I put on my summer yellow.
So I want to start with, you've carved out a pretty unique position in real estate investing. How did you arrive at this point in your career?
How did I arrive? Well, it's been a journey. I've been in real estate for almost just over 2 decades at this point. And really, just a little bit of background. I'm an immigrant to this country. I was born in Jamaica, raised in Long Island. So like you, grew up with a family where when you come from very little, there's very little excuse to not take advantage of what is in front of you, right? So I tease my dad all the time. I did really well in school, but I'd come home with a 95. He said, Anays, what happened to the other 5 points? Let's talk about it. But so very driven family, but really motivated by this sense of taking advantage of the opportunities in front of me. So went to public school in Long Island, but then went on to have to go to Ivy League schools for undergrad and business school. And really how I got here was really tuning into what resonated most with me. I was in banking after undergrad, and I should say the transition into banking was partly because I was an Inroads scholar. I don't know if anyone here is familiar with Inroads, but it's one of the programs that is targeted on at increasing the numbers of talented minorities in financial services. In graduate school, I had a TWIGO fellowship, similarly at a graduate level, focused on increasing the numbers of talented minorities in financial services. And I mention this because even though I went to really good schools, I went to Harvard undergrad and business school, I had no idea that real estate private equity as a career path existed until I was exposed to it through programs like Inroads and through TWIGO. So when I was at the bank, I'd saved up my little bonuses, and I made big money at the time. It was $35,000 a year when I graduated from high school. That was big money. Graduated from college, but I saved up my bonuses, and I bought my first piece of property around the corner of what is now the Barclays Stadium. I renovated it, lived in it for a year, rented it out while I was in business school, and then recognized, passive income is something I like. And so I was exposed to real estate private equity as a career path when I was in business school through the TWIGO fellowship, and then networked my job at Clarion Partners, where I spent the majority of my career until this past year, basically growing up in real estate private equity, getting exposure to asset management, acquisitions. The majority of my career at Clarion was as a portfolio manager, so investing throughout the U.S. and Mexico on behalf of institutional investors in all major property types and in across the risk-return spectrum. Ultimately, last year, over the past few years, I had been trying to tune into, that this is the thread, right? Listening to what continues to resonate. I was feeling called to do something a little bit different. I was feeling frustrated that very little, and I invested or managed almost $10 billion in assets under management on behalf of my clients over the course of my career at Clarion. Very little of that went into communities similar to the one in which I grew up in Hempstead, Long Island. Does anyone in the room know Long Island? So Hempstead, really different in terms of access to opportunity than Garden City, Long Island, which is 3 miles away. So I thought about, how do I, at this point in my career, where I'm extremely privileged, I've done well, I still feel passionate about the work that I do, particularly when I think about investing on behalf of pensioners. I was passionate about one of the vehicles that I was managing at Clarion. It was the first time in the course of my career that my parents and my sister had been able to invest in a vehicle that I was working on. It was a non-traded REIT equivalent. But I really, it was time, Claire, to do something where I could support greater levels of institutional investment into places like Hempstead, New York, where we could think about channeling institutional capital in ways that would support more equitable outcomes for folks that look like me, for communities that look like the one I grew up in.
And so that's a nice segue into, I was going to take us now to the present day, and you said taking a different approach. So let's dig a little bit deeper. So tell us about Lafayette Square's approach, what makes it unique.
What makes it unique? So we are a pandemic baby, we like to say. The firm was formed in November of 2020, so still very much a startup. Thankfully, with some strong institutional capital, Morgan Stanley, the Ford Foundation, amongst the groups that backed us with working capital. And really the focus of Lafayette Square, which is principally today a middle market credit shop investing in $10 to $100 million EBITDA businesses, the focus and the theory of change is that we invest both financial capital plus services, which are effectively investments in human and social capital in ways that support more equitable outcomes. So we're focused not just on the places and thinking about channeling capital into the majority of the U.S. that for any of the real estate folks in the room, you know that it's like the Smile States, the New Yorks, the potentially Atlantas, the Los Angeles, Californias, that get the majority of the capital, right? And so, but there's a whole portion of the country in the middle of America, outside of Midtown Manhattan, that does not get the same level of access to capital. So we are focused on channeling capital into places that typically have been overlooked, underserved, and in a way that supports more equitable outcomes. We're not doing this in a charitable construct. In order to scale real solutions and sustainable outcomes, from our perspective, it needs to be market-driven. I'm a conscious capitalist. I still believe in making money, but I think capitalism has the opportunity to drive the most sustainable solutions to address societal issues that we're dealing with today. And just to give you a couple of stats, one of the things that, as I started to think about this work and research this work, that continued to absolutely break my heart was looking at inequality in the U.S., right? And we know this intuitively. We know it intuitively. But if you look at data from the end of the teens, the top 10% of households in the U.S. by wealth control 77% of the wealth in the U.S. The top 10% control 77%. The bottom 1%, bottom 50% of households control 1% of the wealth. That is stark, and the issue is getting increasingly more challenging. 50 years ago, when my parents moved to the U.S. from Jamaica, there was a 90% probability that I would out-earn them, that me and my sister would out-earn them. Today, it's a 50% probability. So we really need to think about ways that will address the shortcomings of our society as it is today, and think about ways that invest in people and places. There have been, a number of regulatory changes over the course of the past 20, 30 years, which have helped in many regards. The Community Reinvestment Act of 1977, for example, which is in the process of being modernized. It helps, but we really need to focus on a move beyond stability to mobility, and thinking about how we support people in maximizing their potential. So investing not just the financial capital, but making investments in human and social capital so that we can scale more socioeconomic mobility into more equitable outcomes.
So this gets into the next question I was going to get into, which is about affordability, right? Major issue here in the United States and many other markets. What kind of conversations are you having at Lafayette Square, and how does your investing approach tackle the affordability issue?
Sure. So I'll say, number one, we think holistically about investing. So it's not just about affordability with respect to housing, although that is a fundamental tenet. As we look at affordability in the U.S., it's become increasingly, challenging, certainly with interest rates rising over, 400 basis points in the past year. The challenges between owning and renting, the gap between being able to own and rent is probably as high as it's ever been. And so we recognize that we absolutely need to think about addressing housing, but we also want to think about investing in communities holistically and thinking about how we provide access to those who have been underserved in a variety of ways. So we think about mixed income housing, for example, and mixed income specifically as opposed to Big A affordable. Big A affordable has its place. Again, we need to support the most vulnerable in our society. We need to focus on stability, but we also need to support mobility. And mixed income housing, where there is real economic connectedness between social classes, has been, from a data-driven perspective, demonstrated to yield higher levels of mobility. So we think about mixed income housing. We do a lot of work thinking about how we partner with the public and private sector together, public, private, social, in order to scale dollars into mixed income housing. We think about, again, holistically supporting greater levels of access to primary health care, for example, through healthcare real estate. Thinking about addressing food insufficiency through investments in grocery-anchored retail. We think about supporting greater levels of job density through even industrial warehouses, one of the best performing asset classes from an institutional perspective over the past decade. So we think about it holistically, and we think about investing in again, the people and the human capital to support their mobility. If we invest in people, they're better able to pay their rent on time. They are better, more productive in their members of your workforce. That they are more engaged. There's less likelihood of turnover. So as we think about it again from a market construct, investing in the people ends up yielding a better risk-adjusted return for us. We are effectively de-risking our investments by investing in people. So we think about it holistically as we try to address the affordability crisis. So that's part of it with respect to how we're investing, with whom we're investing, and thinking about the broader circle. There's a role that each of us has to play, again, as well as we think about affordability, thinking about advocating for greater levels of densification in our communities. Mixed income housing, greater levels of density are important when we think about addressing the supply constraints. Which is, we don't have a demand problem when it comes to housing, it's a supply problem. So we're trying to attack the supply problem in a number of different ways.
Okay. So we started this conversation, I started this conversation with Lafayette Square's mission, creating investment opportunities in overlooked places and underserved markets. So $1 million question, how can an investor put their money to work at Lafayette Square? And what does the future hold?
Well, I am prohibited from soliciting investments, but I will say we have a 10K. So if mission driven investing is of interest to you, you can take a look at, we are publicly registered, and we are incredibly transparent with respect to the work that we are doing, the investments that we're making, how we are thinking about impact, the KPIs that we are utilizing in order to support greater levels of impact, and the ways in which we are supporting workers in the companies in which we're investing. So I can say that. You can look at our 10K or 10Q.
Well, thank you so much for being here. And thank you, everyone, for your time this afternoon. Anays Payne, Managing Director of Real Estate at Lafayette Square.
Thank you very much.
Thank you, Anays and Claire, and thanks to all of you for joining us today, and our other fantastic speakers. So, of course, a big thank you to our presenting sponsor, Principal Asset Management. Thank you so much. And Bloomberg Invest continues at 1:30 down on the 7th floor with Mark Lassery, Chairman and CEO of Avenue Capital Group. So thanks so much for being here. Awesome. Cool.